You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, managing the cost of life insurance plans.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, and with me today, my co-host Eric Palmer. All this week, of course, we're talking about life insurance as income, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. Yesterday, you need to catch up, watch the show, just head out to our site, brokersalliance.com. As soon as you come to our homepage, hit the red on-demand video button and watch yesterday's show, because really, that's a huge yin and yang. I'm sure we're going to hear from the certain purveyors of mutual funds, as well as some of the financial trade magazines, which I call financial pornography. So, okay. But today we're talking about managing the cost of life insurance plans, because we ended the second segment yesterday talking about here's our expenses, which we have been declaring, by the way, since 1990, at least my career. And I have to say, the mutual fund and 401k industry just coming to the table with all this.
Right.
So 30 years later, you're a little late to the game, but I guess it's better than nothing.
Right.
Eric, let's talk about the number one issue. It's the only issue we can mitigate on a design issue, and we're going to get into designing your proposals later on in the week as well. We have to pick the right insured. Now, everybody gets messed up about this, and we have to remember that 98% of all life insurance for income is a non-qualified scenario.
Well, exactly right. I think that we tend to forget sometimes that with life insurance, we have a little bit more flexibility when it comes to supplemental income planning. And you know, in the spirit of September Life Insurance Awareness Month, I think one of the biggest things we want to push is that, first and foremost, life insurance is more than just an indemnity plan. It truly has matured into being something that we're really focusing in on for income. And when we're talking about income and retirement planning, a lot of times we kind of get lost in the qualified money world, thinking, oh, I can't really change things, ownership issues and whatnot. Life insurance is funded with non-qualified funds in the majority of the scenarios that we're talking about here, and we have the ability to be a little bit more choosy in how we set these things up, and there's some moves that you can make that can make a significant difference on how far that dollar will go.
And we're going to have a couple examples, because these differences are so huge, and this is why I want to always go in and say, who has the lowest cost of insurance once we determine the lowest death benefit we can for these plans.
Right.
And we're going to get into that later on in the week as well. But I want to talk about the insured. Now just remember that 99% of the time, if you have a male and a female, same age, and the same non-smoking health category, the female is 8 years younger on the actuarial table. Now, because of that, her COIs are always going to be cheaper. Now, let me just add to that health categories. Right. So if my female is super preferred, preferred plus, preferred, standard plus, or standard, those are 5 different price tags to the cost of insurance.
Right.
It really matters to me to use a female if her COIs are going to be cheaper, if she's equal to her husband or less, the numbers are just going to be there. But what about the health categories? Because I've noticed, and I'm not saying this is true, I've just noticed a pattern of underwriters that women seem to get better underwriting than men of the same age.
Well, and I don't know, and I don't know if there's any significance to whether it is because they're female or that maybe they truly are healthier. But you're absolutely right. And a perfect example of that is that, here's an example. We're working on a case for a husband and wife. We had a 53-year-old male. We ran it with one of the insurance companies that we'll talk about later on in this week. And the all-in year one expense, so cost of insurance, admin fees, the whole 9 yards, was about $2,900 and some change. So we're putting $15,000 into the IUL, and the male on a preferred non-tobacco had about nearly $3,000 in cost in year one. His wife is 51 years old. We took the same $15,000, we put it in for the wife, we suppressed the death benefit, we ran it optimally, and it was nearly $1,000 less in total year one cost. Now you compound that over the course of 15 years before they want to trigger their income, we were able to produce I think it was somewhere around 10 or 11,000 more income on the wife. Now the husband and wife, they've been together a long time. It was right for them. We made the proposal and we said, hey, look, we think we should probably do this with your wife. They were happy to do it, and we made them a significant amount more of income potential than we would have with the male. So
right from the get-go.
From the get-go. So you've got to look at a husband-wife scenario every single time like that, because at the end of the day, you're doing a disservice to your client by not pointing out the fact that you might be able to put them on a cheaper chassis with the spouse.
When you think about it, the husband could have owned this contract. He could be the beneficiary, but I want the best person in the family with the cheapest COIs, the cost of insurance, so that I can do what Eric just said. When you think about this, this is worth anywhere between 30, it depends upon the age and so forth, 35 to 50 basis points internal rate of return over the life of a contract. And you just said, what was the difference in payout?
It was nearly almost $11,000.
See, that's just too much to not look at. That's why we say, since we're in non-qualified land anyways,
right,
I want to always cherry pick out who is the best person. Now, I just want to bring this up. We'll give today, if you want to say, hey, I want to look at some of these numbers, I want to see how long my client's going to live, because the longer they project on especially super preferred or preferred plus basis, I have to see how long I'm going to keep that income. We look at this because in the 2001 CSO, which we'll give you, just write me at thebiz at brokersalliance.com, and I'll send it to you, that and the Society of Actuaries 2008 VBT tables, because it actually gives us relative risk, a little bit more updated. That number, those numbers really prove our point, and if you want the 2001 CSO or the death per thousand rate, we'll send it to you right on the order.
Well, and I want to preface something too, because it's really important for compliance and suitability that we point this out. The scenario I just gave, for example, in no way were we talking about an indemnity sale. So the life insurance component of the sale was not in play here. If we needed to make sure that we had life insurance on the husband, we would have sold a different policy, and we would have separated from the income plan because we needed something to address indemnity. So you got to make sure that if you're going to look at the spouse or you're going to look at the wife, make sure we got the life insurance side of the coin covered as well, so that we're not interrupting anything along those lines.
Good point. And remember, I am a premium purist. I don't like mixing indemnification and income scenarios on the same policy. And I think clients like this because they see that what are we doing? Trying to keep the cost of insurance as low as we can. When we come back from the break, we'll address the insurance justification with surrogate insureds and life insurance retirement plans. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaways at thebiz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas on the show, always consult your tax advisor and your broker-dealer compliance department. And we're talking about this section, insurance justification with surrogate insureds and life insurance retirement plans. Well, when I think about using somebody other than dad, which has been the traditional play, because remember, we're in non-qualified plan market. We have total flexibility here. Right. Sometimes I want to use mom, but sometimes mom and dad aren't the play here. And I want to look at the next generation down. Now, insurance justification is a big issue. Right. The insurance company's going to want, if I have $250,000 on mom and dad, and I look at income on the child, and that income number, even at the lowest suppressed death benefits, $750,000, right, this is not going down.
Right, exactly.
So talk a little bit about insurance justification, because it can be done, but it has to be done right. But remember, mom and dad have to have decent size of amounts of insurance.
Well, they have to have a decent amount of insurance, and there's also some things that you want to explore. Is there an inheritance? Is there, what's the size of the estate? What are we up against in order to create the justification for the death benefit component, especially because if mom and dad want to put $10,000, $15,000 a year away, and we've got maybe their child's in their 18, 19, maybe 20 years old, 21 years old, that's going to buy way too much death benefit. We're not going to be able to justify that. So we want to make sure we start looking at things like inheritance, what's the estate value, what's the transfer value, what's the child going to inherit, and that's going to help us justify some of that cost.
And if you have more than one child and everybody's young and healthy, you could spread it out with your children.
Exactly.
And I don't think you're going to have any hassle there on justification. Now, the big thing that I want to give heads up is the moment you start going to younger people, and it's a good thing, COIs are going to be dirt cheap.
Right.
However, contract maturity dates are everything, because remember, we're doing this income for mom and dad. We're just using the insured or their actual COIs for the cheaper insurance because we want the internal rate of return to be great. So keep in mind, when I look at maturity contracts, now, why do I care about the maturity contracts? Now, Eric, what happens? I mean, I'm just thinking how the worst scenario. Right now, our contracts go, some of these contracts go at 120. There's one carrier I know that we have that it's 131 maturity date. But what happens if the client was to default? This is why I keep bringing up this contract maturity date, the endowment date. Why is this important?
Well, I mean, there's a couple of different things. First and foremost is you don't want these policies to end before they get to the point of distributing the income out or lapsing or anything else, because you're going to create some tax issues. But also, when you're talking about taking income out for mom and dad, your time horizon is everything. You know, we have a lot of moving parts in these contracts, and so if we're actually trying to take income out for mom and dad, and we've got the contracts maturing at any given point, then we start to lose some of the benefits ultimately inherent in these contracts themselves. So, you know, there's a lot to consider in terms of surrogate, and also I even throw out the idea of legacy planning. Don't forget about the grandparents. They want to leave lump sums, or they want to pass something on using the grandchildren. What better way to pass something on than an income stream rather than a full-on death benefit? And a lot of times, we're irresponsible human beings, and if you get me a lump sum of $500,000, I'm going to probably go buy my favorite car. So, you know, the reality is, when you're doing planning strategies and you're starting to talk to people, and we're running into issues like maturity dates and so on and so forth, think about why you're positioning the insurance and start thinking about the timeline. The timeline's most important.
What's so important to me, besides the maturity date and endowment date, and this is because some of our top carriers, I'm thinking one in my mind is number one, they actually, whatever premium we solve for, and we'll show you this when we get into illustrations, we're going to talk about this all throughout this week. Think about it. That number does not stop at age 100. Their payout goes to 120. If my 25 or 30-year-old daughter is being used as the insured, and we were able to justify it and get the contract in force, that means that past that time, right, and if she's possibly the owner, the secondary owner, there could be a play for her. I died at 90, but there's still money left in the contract that's willing to be what? Either taken out with a policy loan or maybe even pick up withdrawals to basis if I haven't used it. There's all kinds of tactical issues here. The younger the agent, or the younger the insured, one of our actual carriers actually will extend this past 100. So whatever their 100 payout is, it actually goes past that date.
Right, exactly. And because these contracts endow so far down the road, like you said, there's two generations of income streams that you could be presenting to your clients. Because remember, we're solving the income to age 100. In some cases, some of the companies that we'll talk about, they solve the income withdrawals all the way to age 121. I mean, that's 60, 70 years of income. Mom and dad are going to be long gone. They may have taken 30 years of that income, but there's still 40 years left for you. So when you're making these presentations, keep that stuff in mind. You could be making multi-generational income strategy sales here, and it's going to blow away your clients, because when they're thinking about my 401k or those alternatives that I have, those plans cannot do that. Mathematically, it's just not possible.
And remember, even in business scenarios where I have maybe one or two partners and we have differences in ages, let's say Eric and I, we have a difference in age. We're two different generations, Generation Y and the baby boomers. When you look at this and we were partners, I would still do for income, even for both of us having the ownership so that we both have access to it, he should be the insured. His numbers are going to be superior to mine all day long. I'm assuming you're a non-smoker, right, Eric?
Yeah.
You're not doing anything bad?
No, we're good.
And your urine analysis will be okay?
Prefer non-tobacco, I hope.
I would just hope, well, I was kind of hoping for super, But if we're business partners, that's another thing you're looking at, because non-qualified life insurance in a business scenario can be huge. And I'm just going to give this as a tidbit. I'm not going to talk about it today. In a business scenario, you may be able to get tax deduction equivalent, balance sheet equivalent. It's not a tax deduction, it's not a tax credit, it's just the equivalent.
Right.
So think about this. I want you to start thinking outside the 9 dots is what we're really saying. Not just using the best COIs, and 90% is going to be female, but now I might be down the next generation using my kids, and maybe I'm looking at different scenarios in businesses, all to keep the expenses down as low as I can. And remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.